Good morning, everyone. Welcome to the new week. We are Monday, September the 22nd, 2025, recording this in the morning, as always. Let's have a look and see a little bit what's going on. Not a huge amount of sort of economic data or obvious sort of catalysts. What we do have this week, and starting today, is quite a lot of central bank speakers. The most important thing this week, of course, is going to be Mr. Powell. Jerome Powell is speaking actually tomorrow at basically lunchtime, 12:35, speaking on economic outlook. And that's just going to be interesting to see whether he changes the tone of his message compared to last week's FOMC sort of meeting. You'll remember that last week he indicated that he was going to be data dependent, but the shifts the risks to both sides of the mandate were now sort of balanced, and he was a little bit more concerned about unemployment or the potential for unemployment rising. So let's see what he has to say. That'll probably give the market its main direction. And the other people we have speaking today, we have the voter, we have Williams, who's a voter and speaking. He's a bit of a dove, so we'll get that sort of perspective. We also have Musalem, who is voting and is a little bit more for a centrist. And we also have Hammock, who is a non-voter, but she's quite hawkish. So she'll be giving the hawkish side of things. So just going to be interesting to see where the different members of the Fed are pushing, and will they confirm the market's pricing and the dot plots. We also have today the super dove, Trump's puppet, Mr. Miran, speaking. So we'll see what he has to say. It's interesting. Oh, here we go. He's speaking at lunchtime. Yeah. Okay. So let's just see what they say in terms of the market pricing and the dot plot. Remember that the dot plot was revised a little more dovishly to give us 3 cuts, including what we had last Wednesday. So at this point, the market is still more or less following the dots. You can see here that for the October meeting, we have almost a full cut priced in. So that's 91 basis points, which equates to roughly about 23 sort of basis points. And then by the end of the year, we have a 1.7 cut. So that's come down a little bit. Technically, the dot plot would tell us that there are 2 full cuts coming by the end of the year, but the market has been a little bit more circumspect and is just pulling back a bit. What we also have to see this week is the initial jobless claims. We saw a couple of weeks ago, which sort of upset the market, that they spiked up to about 260,000. It seems in retrospect that was kind of a statistical error again. And last week they were down at quite healthy levels. So again, this whole idea of, is the US economy not failing, but is it sort of weakening? Is the labor market weakening? Was the cut justified because of like an insurance cut? We'll get a little bit more data, not a huge amount. We also get this week the core PCE. I believe that's on Thursday. I'd have to check, maybe Wednesday, but I think it's normally on a Thursday. So let's also see if that's in terms of the inflation mandate, how we're going with that. So we have the core PCE, looks like the 25th there. Anyway, we'll talk about that later in the week. But in terms of other stuff, not a huge amount. We had a call between President Xi and Trump last Friday. I think the market was overall underwhelmed. There was some talk of potentially organizing a TikTok deal. Okay, great. But in terms of sort of strategic realignment or a sort of a breakthrough on the tariffs or anything, we didn't get anything from that. And also after the meeting, there was a readout, a kind of a summary from the People's Bank of China, in China, of course, which basically said that there was no sort of substantive change to policy necessary. What is interesting, just something I picked up, is that it seems that there was a $400 million military aid package to Taiwan, which Trump actually sort of delayed approval for just before the phone call, or just into these most recent negotiations. So it seems that behind the scenes, Trump is quite keen not to antagonize China and is trying to sort of throw them a little bit of sort of meat to keep them in the good books. So China's playing pretty tough. And I was listening to a podcast over the weekend from Gavcal Research, very interesting, very informed on China, essentially making the point that it's not really in anyone's interests at the moment to go to war. There's been a lot of rhetoric about Taiwan and the US and China and the South China Sea, but Louis was it Gave? He was making the point that actually, in order for the US to sort of construct their missiles and their high-tech military equipment, they actually need a lot of the rare earths which come out of China. So it's quite a delicate situation in terms of the supply supply chain, and it's not really in anyone's geopolitical interest, or it's not even really a winnable war for either China or the US to engage themselves in any kind of hot kinetic war. And so at the moment we have just quite a lot of posturing. It seems as though the US is happy to just have a sort of a stalemate with China, and China is essentially happy not to give away too much. But having said all that, China is reading as well. I think I mentioned this the other day that their deficit is now the highest it's been of GDP for quite a few years, and that is giving a sense that at least in the Chinese equity space, that there is some kind of sort of support, sort of floor in China. If we actually look at China here, where's the Chinese stocks, you can see that they've been on quite a tear for quite a long time, just sort of maybe having a bit of a pause at the moment. But the CSI 300, which is kind of like the S&P 500, doing pretty well. We also see the CN 50, the top 50 stocks there, also at highs. And we also see the Chinese mainland stocks, which are traded in Hong Kong, also doing pretty well. So overall, China seems to be just going into this situation where they're just trying to stabilize the geopolitical situation with the US. They're trying to form alliances as much as possible with, for example, India and Russia. And we saw that sort of famous photo at the sort of meeting the other day with Putin and Xi and Modi of India. And so there's definitely just some alliance building with China, keep the US at bay, and in the meantime support the home market. And that seems to be what's going on there. In terms of other markets, let's have a quick look around. Volatility remains at pretty low levels here. As I was saying the other day, there was a slight spike upwards in the vol 2 or 3 days ago. That was probably the event risk of the Fed, and also there's been quite a lot of demand for calls. So also upside protection in a certain sense. So right tail risk, which is unusual. In terms of equities, again, there's nothing negative to say about this chart. People can talk about increased stress on the consumer, the K-shaped economy. I mean, there's been a lot of stuff going around by commentaries essentially saying that 50% of US consumption is the top 10% of the economy. And whilst that may be true and may eventually cause social dislocation and social problems, social tension, the reality is if those consumers are consuming, that's will keep that sort of the services sector and the goods sector sort of rolling along. But anyway, just from a purely technical point of view here, you see that the US equities above all the moving averages, strong. We look at NASDAQ, also strong. Even the Russell, the small caps had a big breakout, on Thursday after the Fed with those interest rate cuts of 25 basis points. So, everything looking quite good at this point. Are there some cracks in the US economy, in the US labor market? Yes. Is it time to launch a big short? Probably not. I mean, if we look at the equal weight, you can also see that the equal weight ETF, the RSP, also essentially doing pretty well. I mean, it was dumped at Liberation Day, but ever since then, there's nothing negative to say. It hasn't even really breached the 20-day moving average, let alone the 50 or the 100. So that's doing well. And if we look at the Mag 7s or the big tech stocks, there's not much to say. You can see that it's actually pulling away. If anything, that would be a healthy retracement back towards maybe even the 20-day moving average would be useful and healthy. But at this point, the US tech sector and overall stock market doing very, very well. So there's nothing much to do there. In terms of the bonds, if we look at the US space, let's just look at the US space. I'll bring up the yields. Here we are. So you can see the front end of the yields. They came down. We had those revision numbers at the beginning of August for the non-farm payrolls. And essentially then the market, priced in the cut. We got the cut and that was fully priced in. So you can see here a little bit of a technical bounce off that level of about 3.46. So that this level here, 3.46, 3.45, that does seem at the moment to be, a bit of a floor for the yields. And I would estimate that probably the 2-year, I don't really anticipate these yields, massively rising because the Fed has made it clear that in some shape or form they are, generally cutting over the next few months and even sort of 12 months. So I think that the 2-year, it'll probably just range. That'll be a floor, maybe just at the moment 3.46. Let's call it that, and maybe can meander up a little bit more, another 5 or 10, 5, 6, 7, 8 basis points, depending on economic data. But the front end of the curve fairly fairly anchored, I would say. What's interesting, if you look out then at the 10, you can see that's gone a little bit more up at the long end, and you can see here the 30-year also compared to the front end. So definitely there is a sort of a steepening bias. The back end of the curve is trading a little heavier, shall we say, than the front end of the curve, and that's going to be affected by inflation data, for example, the PCE we get this week. It's going to be affected by the general economy. If the economy is doing well, no reason for those yields to collapse. And of course, there's going to be other stuff or other factors such as, sort of long-term issuance, treasury issuance, bond auction performance, those kind of things. But at the moment, it's still relatively contained. Remember that just a couple of months ago, the 30-year yield was above 5%. So it's now come back, 25, 30 basis points. So nothing too scary to worry about there. So all in all, relatively strong situation. The market, which really does seem to be unstoppable at this point, is gold. I've just got the spot gold up here. You can see here breaking out of this wedge, obviously, all the moving averages, well above all the moving averages. Again, a little bit like sort of the Mag 7. If anything, a healthy retracement down to the 20-day EMA would be, sort of completely normal, or at least down here, let's say 36.20 or so. But gold ripping higher and taking with it silver. You see silver here also continues to rip higher, although we do have a bit of an overhead resistance here. If we put this on a weekly for silver, let me just sort of zoom out a little bit. You can see here, just look at this level. This is a very important level. This level, which silver has reached going back all the way to 2011. So 14 years ago. This is a pretty crazy, well, I don't want to say crazy, but a big move in silver. Put it back on the daily chart here, and also gold. And you have to say that seems to be where the pressure is coming. The market is saying, okay, inflation is still a bit sticky. You guys at the Fed seem, quite happy to have inflation around about 2.5, 2.753. You're not trying to get it really down to 2. Deficit issuance continues to be crazy. We have deficit spending. The dollar is going to be debased. Fine. So we'll start building up precious and semi-precious metals, and that's why we're seeing continuing to see this huge bid in gold and silver, and especially for gold, I don't see any real reason for that to come off as long as these structural sort of situations are still in play. What is interesting is just to look at copper. I'm going to look at the London copper price. You see here that, it's okay, but generally you're not doing too much and certainly not following silver and gold. You see here it's sort of lagging the other metals here. And that's possibly a little bit of skepticism about global growth, and maybe in the more approximate cause would be the lack of, a real breakthrough with the Chinese sort of American talks or phone call, which we had last Friday, as I just mentioned, between Xi and Trump. So copper there, just let's keep an eye on copper there, because ultimately the world does need a lot of copper for electrification, data centers, electric vehicles, et cetera, et cetera. You know that story. Is this sort of a bear flag here, just sort of, grinding up here, which it could fall down a little bit more? Maybe. But certainly not nearly as powerful as the precious metals. Just finally, we just want to have a quick look at oil and the US dollar. If we look at the US dollar, and also just talking about the US dollar, you can see the US dollar the last few days, has had a tiny little bounce, and that just makes gold even all the more impressive. The gold just continues to go up. Although, is that actually telling us something? That the real story is that global markets are seeing essentially a debasement sort of theme of fiat currencies with these deficit spending. I mean, even in good economic times now, governments are simply refusing to show too much sort of fiscal discipline. US, Europe, France, Canada, all countries are spending a lot of money, and basically it seems as though that genie is out of the bottle, and the days of having austerity just seem to be politically unacceptable at this point. So the pressure is really going to come. There's going to probably be a sort of continuous upward pressure on bond yields at some point, or at least, we're not going to go down to a lower neutral of, 50 basis points or 100 basis points. And the second thing is that probably just the currencies are slowly going to sort of lose value. We're not going to really notice that against each other. It's going to be things like real assets, hard assets, real estate, gold, maybe even Bitcoin, things like that, which are going to pick up the slack. Anyway, we see US dollar here just not doing too much. It had a little bit of a reactive bounce after the Fed. You see it's been up a little bit, but again, already pausing at the 20-day moving average. And to be honest, I'd be surprised if that grinds, let's say, higher than 98.6, because as I say, a lot of structural factors are against that. Not necessarily that it's going to collapse, but I think the US dollar at this point, I don't see a huge amount of extra strength, certainly above this level here, which seems quite key, which is that 98.7, something like that. And that's being reflected if we look at some of the cross pairs. Let's have a look at the euro. You see the euro was sort of went off for a couple of days, but it looks as though it's pushing a little bit higher. We see the Swiss franc continuing to overall to show a lot of strength. We see the pound. Let's have a look at the pound. Came off against the US dollar. So really, let's just see what happens this week. The US dollars had 2 or 3 days. Let's see if it bounces back. And then if we look at the yen as well, looks as though that's starting to stall out, and a bit more technical resistance on the USD JPY. You see here it's hitting the 200-day EMA here. So that might be the resistance level there. So anyone looking to short JPY, that could be an interesting level. Okay, guys, I'll leave it there. As I say, a bit of a sleepy start to the week. Let's see what some of the central bank speakers have to say. Not really any data today. Tomorrow we get Powell, which will most probably give the next direction to markets. Thanks very much. Have a great day and have a great week. Thank you. Continues tomorrow.